Okay, I think we already have a very good number of attendees. Good morning again. My name is Gabriele Pesce. I'm the Director for Innovation and Sustainable Finance here at Empower, the District Heating and Cooling Association in Europe. Today, we're going to speak about sustainable finance in district heating and cooling, quite an emerging and more important topic. And I'm very glad to see that we have more than 140 register participants. So it's quite clear that this topic is becoming more and more relevant also in our field. So I'm very glad to discuss this topic today with our expert. We're going to have quite a good number of presentation, more or less technical, of course. Usually when we spoke about finance, heating and cooling, I see a great interest, but also some difficulties in understanding this topic. It's, of course, it's quite complex because of the inherent complexity of our infrastructure. And that's true, in particular for sustainable finance and the some regulatory framework we have in this topic, where it's quite complicated to apply and to understand what is green, what is not green, how to also support private investor in investing in our infrastructure, because of course this heating cooling is and can be a very green infrastructure, able to integrating different heat sources from domestic sources, from geothermal, waste heat, and so on. But of course, it needs financial support. In a recent study from the Aalborg University, we calculate around 144 billion euro until 2050 to reach a full decarbonized scenario. And you can understand it's quite a big number. And of course, this heating cooling is not the only infrastructure needed for funding. Of course, this heating compete a good way with other, maybe sometime more mainstream energy infrastructure or energy technology, such as the wind, solar, and so on. And in general, the narrative is that this heating cooling is quite a risky investment. So the idea is to understand how to make for investor investment in this heating and cooling less risky. Also, to make them understand how this heating and cooling could be a very good investment, but also to understand which are the main elements that hinder investor investing in our industry. So this webinar in particular is also sponsored by the IEA-DHC Annex that finance a great project led by Daniel Møller Sneum, which we're going to have a presentation that's try to analyze which are the main bottlenecks and which is the requirement for investor. Of course, Daniel will be accompanied by a great presentation by Tobias Popovic, professor at the Stuttgart University Steinbeis Trans Center, sorry, quite a great expert, one of the few in Europe in this heating and cooling sustainable finance. And then we have also Kristina Lygnerud, another great expert, a great friend of also Eureka Power. She's professor at the University of Lund and senior energy expert at IBL. So a few house rules before entering in the presentation. So the webinar will be recorded. The slide will be shared, so don't worry if you miss something. You're gonna have the chance to rewatch the webinar in our Eureka Power YouTube channel, and also we're gonna share the presentation with the attendees. Of course, I would like to make this webinar quite interactive. So I don't like a series of, let's say, presentation and monologue from the speakers. So I really suggest you to intervene. If you have a question, you have a button in Zoom. Probably after the COVID, everyone now is very expert in Zoom. So I'm gonna repeat it. So you have a Q&A button at the bottom of your screen. So you can ask questions. I'm gonna give some question time after each presentation, but of course, at the end of the whole presentation, we will have a full Q&A discussion where you, of course, you can ask whatever you want to our expert. Okay, so I already spoke too much, I guess. So we can start with the first expert, Tobias. Can you switch on your camera? Yeah. So as you said, maybe I can give you the floor. You can shortly introduce yourself and please take the floor. Thank you, Tobias.
Yeah, thank you very much for the introduction and for the invitation above all. I'm quite happy to present some of the insights we have been working on as a team with Kristina and Daniel, for example, but also from other projects, for example, Reward Heat that we did for the European Union over the last 5 years in a rather large consortium. And the key question I will be dealing with is how to finance the heat transition, especially in the area of district heating and cooling networks.
Perfect.
So, yeah, that's about the start. So at first glance, it becomes quite obvious that we are faced with huge financing needs if we want to make the climate neutrality transition successful. So over the next 30 years, we would need at least something between 90 and 150 trillion in total worldwide. So that makes 5 trillion approximately per year. And that's far more than has been invested on an annual basis over the last few years, which was rather in the area of 1.3 trillion. So that's bad news, but the good news is that the money in principle is there. For example, if we just take as one larger investor group or alliance, the Glasgow Financial Alliance for Net Zero, they have 150 trillion assets under management. So the money is there. The only question is how to channel it into climate neutral infrastructures like climate neutral district heating and cooling networks. So what we did is we took a closer look at different studies that were published over the last few years. And as you can see here, just for district heating alone and for the European rollout, quite some billions are necessary. So if we take a closer look at the state of Baden-Württemberg, which is the most advanced state in Germany when it comes to the municipal heat plants, and now the municipalities have to start implementing the rollout based on these heat plans. So until 2030, we would need in the state at least 10 billion and additional 40 billion until 2045 or 2050 for Germany as a whole. It would be in the area until 2030 of up to 150 billion or 400 billion until 2050. And if we take a closer look at the European landscape, so that would make up to 300 billion until 2030 and up to approximately 2,000 billion, so 2 trillion until 2050. So that's quite a lot of money. And the bad news is that the money, the public households do not have the money. So I brought you here from Eurostat and a current overview about the debt levels in relationship to the gross domestic product of the respective countries. That's one of the two Maastricht criteria. And as you can easily tell from the colors, most of the European countries are above the allowed 60% ratio of debt level. And in particular, for example, Greece, France, and Italy are getting more and more into trouble when it comes to public deficits and public finances, and public debt above all, because they already have too high debt levels. And the question is where to get the money from and how unforgivable this is already getting. I brought you the example of France, for example. Due to the high debt levels, over the last few weeks, we have seen that investors have started to get nervous, which is expressed on the right-hand scale, for example, where we see the spreads. So since the debt levels are considered from an investor's point of view not as sustainable, and this increases the risk of a financial crisis or a bankruptcy of a certain state. In this example, it's France. Due to the higher perceived risk, also the spreads have increased. So that means that in future, for example, France has to pay higher interests on the existing debt already. That's the first problem. And the second problem is that it will get harder to get the financing for once they issue more bonds they need for financing, for example. So now turning the view again to district heating and cooling networks, the crucial question is how to make these projects investable. And the first exercise is to translate it into the decision-making dimensions of institutional investors and also into the language of institutional investors. And for example, we developed this so-called sustainability balance scorecard, which is providing key performance indicators or KPIs for the 4 different relevant dimensions of the so-called magic square. So it's the return dimension, the risk dimension, like already explained with the example of France, where investors are looking at, and their key question is always to balance out the risk and return relationship. Then, of course, liquidity is an issue, and more important has become the sustainability dimension, which is subdivided in 3 different subdimensions, namely environment, society, and governance. And especially in the area of environment, we have, for example, the carbon footprint as one important KPI. And this is also, for example, defined in the so-called EU taxonomy, which is used as some kind of means of orientation for the decarbonization process of the European economy and the European society on the path of the 1.5 degree target from Paris. So if investors or if a district heating project wants to attract investors, it needs to provide at least these KPIs we have displayed here for the investors, and then they hopefully can see at first glance whether it's investable for them, if it's interesting for them when it comes to the risk-return relationship, but also from the decarbonization potential for their existing portfolios. So since investors are rather concerned about risk, de-risking is, so to say, perhaps the name of the game, so to say. And that's what we developed. It's an approach that we developed and also published in the article. The source is given at the bottom of the page. A blended finance concept for attracting investors to district heating and cooling projects. Why is it necessary? Because, for example, in the case of Germany, we have the large majority of projects that need to be implemented are greenfield projects. And greenfield means it's at the beginning of the project life cycle, and in the first stages of the life cycle, we have a situation which is marked or characterized by high complexity, and complexity always means risk. So complexity from a technological point of view, but also from a regulatory point of view, political point of view. And that's basically the sum of all these risks in the past kept investors away from investing in infrastructure projects like district heating. And important investor groups in that area are, for example, insurance companies, but also reinsurance companies or pension funds. And these are rather risk-averse investors, and therefore it's important to provide some de-risking mechanism, for example, that public households or public authorities provide. They take the first loss pieces, or they provide grants and especially guarantees for a particular project. And on the left-hand side, you see this de-risking mechanism. So hopefully by providing a guarantee, this is de-risking the project's overall risk, and reducing the risk means, and that's what you see at the in the center, it optimizes the risk-return relationship from the perspective of a institutional investor. And once the risk-return relationship is more favorable, then hopefully this mobilizes private capital over financial markets from, as already mentioned, pension funds, infrastructure funds, but also insurance companies. And if this so-called blended finance concept, blended means combining private capital from financial markets and public capital or guarantees. If this blended finance concept turns out to be successful, then we hopefully achieve impacts on different levels. For example, the triple bottom line is achieved. So that means that economy, ecology, and society basically all benefit from that. Then that the UN SDGs are met, and especially once again the taxonomy aligned targets are also met. So by mobilizing these funds that might accelerate or might contribute to accelerate the funding of district heating projects, and this ultimately would lead to hopefully a successful rollout all over Europe of district heating projects. All right, blended finance has been also quite prominently discussed at the COP29 conference. I just brought you some screenshots. For example, the Environmental Finance magazine mentioned that COP29 could be remembered as the blended finance COP. So that basically tells quite something, but also communiques from the United Nations or from the IFC stressed basically quite the importance that blended finance might have, and also the potential that may blended finance bring along when it comes to financing sustainable infrastructure in order to make the decarbonization process and the climate neutrality transition successful. Basically, the question is, do we already have blended finance concept in Europe that work quite well and that could be used as role models? And especially in Denmark, we have the example of KommuneKredit. KommuneKredit has been in operation for the last 100 years, and it's basically opening up the global financial markets to the local municipalities. And they are basically using also they have been raising billions of money over the last few years for the decarbonization of the existing so-called brownfield district heating sites in Denmark. And the mechanism is that KommuneKredit as a central platform basically is raising the money via green bonds. So that means it's rather cheap also due to the greenium effect. And that's where the municipalities can benefit from. And also that's why I would call it a blended finance mechanism, because we have the...
Is this one, Tobias?
Exactly. Great.
Okay, great. Thank you, Marita. Thank you very much for your support.
Yeah, and on the right-hand side, you see the guarantees. So that's basically the de-risking mechanism I mentioned earlier. And that's implemented by KommuneKredit. And so if we turn our view on the bottom, so the key question is how to finance district heating and cooling networks, greenfield and brownfield. So be it operated by utilities, by heat cooperatives, or by municipal utilities. In German, they are called Stadtwerke, or by the municipalities themselves. The key question is where to get the money from. And what we did is we developed a proposal for the state of Baden-Württemberg that they could basically adopt what I just explained from KommuneKredit, the concept to the German circumstances. And so basically guarantees are used as a blended finance mechanism. So that makes it more attractive for investors, and the investor groups that are important you see at the top of the page. So it's basically citizens that could enter in these projects by financing heat cooperatives, for example. So they become the owners of the heat cooperatives, and there's also quite potential in mobilizing their money. Then, of course, utilities, promotional banks, development finance institutions, insurance companies, like mentioned earlier, banks, sovereign wealth funds, pension funds, investment funds, and governments. So they all could provide money via this central district heating platform by using instruments like equity, mezzanine, debt, alternative investment funds, or European long-term infrastructure funds. In Germany, we also have from the federal government the so-called Climate and Transformation Fund that could also provide guarantees at least, because there's not so much money in there, but the money they have, they could at least use for providing guarantees in order to support the earlier mentioned risk de-risking mechanism, and also infrastructure finance, for example, in the case of public-private partnerships could be used. And so since this mechanism has been working quite well, and which is also meeting European regulatory frameworks for Denmark, so we see quite a strong case to adapt this concept that works well in Denmark, for example, for certain states in Germany, like Baden-Württemberg, but also for other regions in Europe. And so we are quite positive that in this kind of concept is a lot of potential for the rollout of district heating all over Europe. So, but that's now all I wanted to say. Thank you very much for listening, and I would be happy to take your questions.
Thank you very much, Tobias. Indeed, I think discussion around blended finance for infrastructural investment, and in particular for DC heating cooling, is becoming more and more popular. I can already tell the audience in general that we are also discussing with the Commission to think about blended finance scheme for district heating and cooling. So it's quite clear that this solution, this scheme, could be very interesting. And one thing I would like to say to the audience, I would like to encourage people from utilities in particular, from project developers, to have a say in this, because of course we discuss a lot on academic and theoretical level, and for sure it's quite interesting. But what I noticed that in all my discussion with experts on the voice of utilities, the voice of potential project developers is not really on the protagonist. Because I would like to see and what they think about this kind of scheme-led finance. It would be very, useful for them. So if in the audience there's someone that would, from the utility, Stadtwerke, any kind of network operator, want to ask question and clarification, please do it. And of course, in general, if you have any question to Tobias for the presentation, I can pick up two now or maybe later. I remember that you have the Q&A button at the end. If not, I would give the floor to Daniel from the Research Project Manager, Energy Modeling Lab. Daniel, please. Sorry, I have some works in another apartment next to me. I hope that there's not any background noise disturbing you. Please, Daniel, it's your turn.
Thanks a lot, Gabriele, and thanks, Tobias, for introducing us. I will be presenting some of the results, and I should say these are preliminary results from the project that is supported by the IEA-DHC. We started in April, will end in September next year. So these results are some early glances at what we've collected so far. But the intention with my presentation is also to take in views, as Gabriele just mentioned. So in case you have views or comments, contacts, or especially data, that would be wonderful. So please do share that with us. But today will be a small mixed bag of different good things that we've collected, and also an indication of what we will present at a later point. I'm basing my part of my presentation on the good work by Marian Tam from Energy Modeling Lab and with data collected by Lewis. So just to give credit where credit is due, that has been very helpful. But maybe just a few words on where we started with the project, or the overall objective of the project, which is that we try to identify district heating as an asset class. And asset classes are perhaps not that familiar terms among district heating operators and people. I'll give a very, very brief crash course on asset classes in a moment, but essentially we want to understand or we want to improve the understanding of the district heating sector for people with money in very short terms. We want to do so because we want to bridge the people in the sector, the heating sector, with the people with the money, and essentially provide some kind of parallel between these two modes of understanding investment and district heating. And we do so because we do see a very large potential, as Tobias just mentioned. There's a very large need for finance for heating. And in order to have a better understanding and make more informed decisions, we also need these sectors to understand each other. So that's the crucial parts of our project. So what is an asset class? I'll probably miss out some very key parts of asset class description, but essentially it's a way to categorize certain investments so that will behave predictably in some sense for investors, so that they know that the district heating sector typically predicts like this when markets go like this. And that provides some kind of certainty because investors can blend their portfolios and in that way securitize, for instance, district heating as an asset class, which they know will do this when that happens. And the reason why we use this term is that by categorizing district heating as an asset class, we will hopefully, that's our intention and our hypothesis, we will be able to make investors understand this sector better and thereby provide more funding at a lower cost of capital for the transition that is needed. Some examples from Danish project proposals. Part of the project is to collect some quantitative data, so essentially the costs of capital for financing district heating. These data are very hard to come by. We knew that from the outset. We also knew that in the Danish case, it's typically very much more transparent than in other countries because there is not the same degree of competition and a general wider transparency. So we've collected 48 different project proposals, which is what you develop before you deploy your project. And there you make certain assumptions based on the current markets, the cost of capital in financing these kinds of projects. I should say, in the Danish case, typically it's mainly loan-based. In other cases, you may have more equity shares, but since Danish district heating companies are not allowed to hold a lot of equity, typically you see higher shares of debt. What we did was to look at the different years' interest rates and the bubbles. I'll just explain this chart. What you see on the vertical axis is the interest rate, and the blue dots are the mature projects. So that is what we also call brownfield projects. So existing systems that are expanding or buying a new technology for their existing system. Whereas the orange brownish dots are the new systems, entirely new systems that are more or less happening from the ground up. So these we call greenfield projects. We try to compare them with the long-term government bond yield in Denmark. And perhaps if you want to force some statistics down over these numbers, you may be able to see some kind of correlation with the numbers, and that may be explained by the AAA rating finance that is provided by KommuneKredit, as mentioned by Tobias. In the Danish case, typically banks also provide this. with a very high credit rating, and which intuitively makes sense if it follows the overall government bond yield. We also see, interestingly, that you may know there is perhaps too limited data points to draw a definitive conclusion, but often you consider greenfield projects or mature projects as more risky, whereas the greenfield projects, the new projects as more risky, and then the mature projects, the brownfield ones, where you have a managing board, you have the technology deployed, they are considered less risky. But in our numbers, we don't see a strong tendency of significantly higher interest rates for new projects, and that sort of goes against the typical investor intuition, where you perhaps provide higher cost of capital for new projects. It may be explained by the fact that in Denmark, you don't have the same degree of risk analysis and costing of the risk, because the financing is provided in a way which is to some degree agnostic to the kind of project that it finances. So that's an interesting takeaway from the Danish case. Another one, so this is the conclusions that greenfield is not necessarily higher risk rate. Another way to look at it is that the total investment size that we see on the horizontal axis and the interest rate that we see on the vertical axis, if you're squinting, you may be able to distinguish that there may be some lower interest rates for the lower sizes of investments. But I don't think we should put too much into that, because we haven't controlled for the years. And we do see interest rates changing over the years. So overall, I would, at least at this point, we still need to dive in more into the data. But at this point, I would venture the statement that we don't see a strong correlation between the size of the investment and the interest rate, because of the way that these are financed, where essentially any kind of project will face the same investment conditions, regardless of size and regardless of maturity of the project. Then we have an interesting spread here. The orange one is the lowest average or the lowest interest rate, and the blue is the highest. And as you can see, 2021 has an interesting, and so far we haven't had time. These numbers are quite new, so we haven't been able to dive into them. But one explanation may be that one consultant did the study early on in 2021, another did it later in the process. So I will have to go back and see if that guess could be the right one. But at least we see quite a large spread in these projects. Also, we have a significant larger amount of projects in the later years than we have in the early years. So if we're controlling adding more projects in the earlier years, perhaps we'll see the same tendency. Another approach in our project, we've done a very, very small screening of motivations for investment and divestment of district heating systems. The reason we wanted to do this was to see why are people, or why are investors or owners actually wanting to go into the sector, or why do they want to exit the sector. And we split it into the private and the public, as you can see on the vertical axis, and then some economic motivations or climate or political. You can cut those categories any way you want, and probably there are some overlaps. But what we see is that it can be spread from a focus on the divestment side to wanting to focus on its core service. One example could be a university that is supplied by district heating, wanting to sort that away from their primary activities and maybe give it to an energy service company instead. And on the public side, you could see security of supply motivations for actually entering into district heating ownership. So many different motivations. one of them, and now we are talking about investment and finance, but it also just illustrates that you can see the purpose of divesting in a private case is that you can gain an attractive exit, so you can maybe develop a project and then sell it off to someone else when you've developed it and get a nice return on that. But it's only one of the motivations for doing so. There may be other political, climate, or economic motivations. Then we conducted and are conducting a series of interviews, speaking with different experts, both on the supply side, the district heating owners and operators, and on the investor side. I want to dive in. I think the scaling of this has been slightly changed, but let's just proceed and pretend nothing happened. One of the interesting things is that in the Danish case, defining it as an asset class maybe sticks out in typical investor terms because they have so little equity, and typically you want people to have skin in the game and put a lot of money on the table. So you as a funder or a financing source can top that up. But in the Danish case, due to regulatory requirements, that's not allowed, and still things are working out quite nicely, it seems. So that's one conclusion. The other one, sorry for the red boxes, they have been misaligned in some way. But one of the drivers for investors when we spoke with them is, and I'm sorry, I'm staying in Denmark, but we have conducted interviews in especially UK and Denmark so far, hoping to expand out. Again, a call for you if you have some interesting contacts or want to share your views. Very happy to talk. One of the interesting findings was that investors tend to like the Danish regulation, where you didn't really you have this non-profit principle, but where you also have to carry through cost from whatever cost you're facing when fuel prices increase. These costs are transferred through to the end user. And for investors, this kind of pass-through of cost, we call it cost-based pricing, or that's the sort of the regulatory term for it. That provides increased certainty for investors because they can be more certain that they get their money back when they don't face some kind of regulatory price cap, for instance, that are seen in some places. Of course, we're also looking at the literature. What you see on the right there is our own developed GPT of basically a lot of, especially investment-based, but also district heating literature in general, that we can query and have a nice chat with that. The good thing about that is that typically the big public AIs are not trained on this specific combination of scientific papers and industry reports and IEA and IRENA and so on and so forth in Euroheat. So we can get a nice mix of that without violating any copyright issues. So that has been very helpful. In general, this is a very helicopter perspective view. Many valuable findings on finance and in literature, but not so much on asset classes specifically. Next, we are doing modeling. We are conducting the modeling and building the models right now. We're doing that in the Times Energy System Model Framework, and we do so especially led by the Energy Modeling Lab where I come from and Halmstad University. What we do there is that we provide increased transparency by applying some financial frameworks on a given case, and thereby increasing or decreasing the risk by having a stronger view on what happens actually when you introduce these different kinds of financial frameworks. That's, of course, an interesting finding for our project or a relevant method, but it's also perhaps a generally good decision support mechanism in these kinds of investments for district heating in general. Then finally here, a call for maybe a Christmas gift for us that you could be helpful with. We would be very grateful for data, especially the hurdle rates, the weighted average cost of capital, all these financial data that applied for projects. We don't need to pinpoint it, especially to your company or your country or your We don't need to name them. We can do it Chatham House rules, as it's called. But we would be interested to see this, because then we can feed our models with this and see what comes out under these specific conditions. So please do share if you've got reports, project data sheets or something like that. Very happy to receive that. Also, again, contacts, very welcome and happy to discuss. And then something from us to you. We have some upcoming podcasts from the project. Early 2025 will start, I think. So you can sign up for Energy Policy Cast, and we'll put it out there. Also, our LinkedIn group, you're very, very welcome, and also to provide your own discussion points and questions and so forth. But that was it from my side, and I'll leave it to Kristina. So thank you.
Thank you very much, Daniel. Very in-depth analysis, and I hope to get even more and more results at the end of the project. Even less than already now. It's quite interesting. And also in this case, another encouragement to the audience. If you have any data, any view, any kind of resource can be useful for Daniel's work, please feel free to contact him. It will be really, really appreciated, because one of the main obstacle we have in general is that we lack a lot of data in terms of investment in district heating in Europe, because many of the company and operator don't disclose too much how much they invest. And so also from the Euro Heat and Power side, it's not easy to understand what's going on exactly in terms of the data in investment. We are working on it, but also Daniel. So please, if you want to give him some present for Santa's, contact Daniel. Thank you very much, Daniel. I'm glad to see that already some questions. Probably I want to keep them at the end. We have just one presentation left from Kristina, so please be patient, the audience, I say. And I give the floor to Kristina for the final, very interesting presentation. Thank you, Kristina. The floor is yours.
Thank you, Gabriele. So my background is in business development, and I have been following the district energy sector for a number of years in a number of projects, and I have come across more and more towards the finance part of activities. And as we heard, we will talk a little bit about the asset class and blended finance when we consider some current challenges. So we have heard that there is a lot of financing that should be interested to go for the district heating sector, for the district heating asset class. But is that really the case? So we have seen that the EU wants to invest its way out of the climate crisis, and we have a number of plans to do so. We have the action plan on financing a sustainable growth. We have an ambition to also become energy sufficient with the Repower EU and be resilient. And there are other complementary measures as the Green Deal and Fit for 55 and EU taxonomy. So the whole idea is to make sure that we invest ourselves out of our crisis, but are we successful in the ambition to engage the investor community? That's the big question. And apart from these financial programs I mentioned, we are also investing a lot in research and innovation to build that capability at the same time. But it's difficult to implement the innovations in reality if the funding isn't there, right? So it's all interconnected. So let's see if we are engaging the investor community. The problem with the investor community is that there is an underlying expectation that you will have low risk, high return, and high liquidity in your projects. And at the same time as you have been generating a large box of money for energy transition, you have not really changed the underlying structures of how to motivate investors. So some investors are not really interested in shifting the way they look at their usual risk-return liquidity outcome. And things like district heating with a very long payback might not be appetizing, even though it can have very green elements to it. And also, we have seen from projects, now I'm thinking about the reuse heat project, where we made waste heat recovery from urban sources into district heating systems. So it can be, for example, waste heat from a data center or from a cooling tower on a building, that kind of thing, which is extremely green because you don't have to either expand an existing district energy system, which is on gas, or you can replace the usage of gas from other alternative installations. But the investments were small. They had a bill size lower than 5 million euro, which meant that when we started to discuss these investments for replicability purposes with the investor community, there was very limited interest. And we also tried to investigate if there was an interest to bundle these kind of investments to a larger portfolio. You could have a number of these projects together to reach the 5 million euro threshold. But again, that created other risks and barriers. So you also then tend to miss out on these very green opportunities when you only consider the conventional approach. Let's see. So how can you then make sure there is an investor interest? So you can also link all these three conventional requirements from the investors with sustainability and make it an appetizing investment case. Well, there are different ways to do that. You can either regulate, and in the EU we have seen different ways to regulate recently. We have something called the Sustainable Financial Disclosure Regulation, SFRD. And there you should be very transparent about all the activities you perform. And there is also a certain paragraph indicating that if you are an investor very interested in green elements, then you should go into the impact funds of paragraph 9, showing that you're really providing an impact with your investments. And for district heating, this means that if investors are turning towards Article 9, they will not be interested in combustion technologies, for example. So that means that a large part of the district heating investment possibilities would be out of play for investors. Then we have the EU taxonomy. It's a framework designed to provide a guideline for investments, making sure that they are truly green. So you screen technical assets in a way you haven't done before. It's again this transparency part. But we have seen that the EU taxonomy, it refers to other directives and regulations, for example, the Energy Efficiency Directive and the Renewable Energy Directive, but they are not all coherent. So the inclusion of the EU taxonomy is complicating the estimation of different kind of investments in, for example, district energy. So regulation can be good, but it can also have some adverse effects. Then Tobias already mentioned that you can also try to mitigate risk by providing some kind of public guarantees. And something which is much discussed now is the concept of blended finance, which is there to kind of target the fact that we don't have the structure for financing that we need to meet the ambition that we have investments in sustainability. So because we have this very firm lock-in into the current structure of risk, return and liquidity, we need something to offset the sustainability risks, so to say. And blended finance is a wide concept for saying that you combine money from different sources, where you have public money, municipal or state or whatever it might be in different combinations as a basis, and then you can top it off with private or other stakeholders around a certain investment projects to engage then the investor community in the energy transition. And that way you could possibly then have an engaged community. And I will not have such a long speak. We will instead devote our time to questions. But just rounding off, there is many conflicting items in the regulations occurring on the EU level. One, you want to reach climate neutrality, you want sustainable investments, you put a lot of money and research effort into play, but you kind of forget to also upgrade the financing part of the game, which means that we will have a status quo. Thank you. I think we can there move on to questions, Gabriele.
Thank you very much, Kristina. I think your message is quite clear, and I really much agree on that. I think the Commission and general institution are working a lot now on finance, but of course, it's not still sufficient. Sometimes there is a discrepancy between the need from real investor and project developers and the regulatory framework. So let's see what the next Commission will bring. But of course, also thanks to your analysis, we can also try to advocate for real, I think, useful outcomes. Okay, as you said, Kristina, it's time for a discussion. We have already quite a nice number of questions, so I will prioritize audience question. I still encourage people not to be shy and to speak up. You can type your question in the dedicated box. So I start with Sam Oxenar. Hi, Sam. Question for all panelists. So feel free to reply. Thanks. You have been looking at how to make this heating and cooling interesting for investor. Could you say anything on how to align this with being able to deliver the district heating and cooling services at a competitive price? We see now that especially in brownfield developments, it's hard to find a price point that is attractive for investor and a user. I think it's quite a long-standing story here how to harmonize economic feasibility and competition with fair pricing. Who wanna reply to Sam? Feel free to raise your hand. Otherwise, I will point. I will decide. Daniel, okay, you can start.
Maybe I can give a first go, and maybe Sam, thanks for that question. I think allow me just to take a step back, because I just the other day was considering the deployment rate in Europe and in the world as a whole. We spent, let's call it a century or maybe 1.5 century on getting to around 10%. In Europe, it's a bit more. Depending on which study you're looking at, Euroheat and Lund University's study, or Fraunhofer and other people have made different studies, but let's say that we are aiming to between 25% market share or 50% roughly. We need to increase this deployment rate from maybe a percentage point every decade to a percentage point each year or every second year. This is just in line with all the other urgent messages that we see from the IPCC and from the renewable energy industry, the electricity producers, that things need to go extraordinarily fast. And so now I'm getting to answer your question, but it's just to say that if we are expecting the market to solve this in 20 years, I'd be slightly skeptical. So I'm personally, I believe that we need some quite strong intervention from the government or the state. And getting to your question, I'm not sure that we will see purely market-based incentives to see these deployment rates. So there, perhaps we're moving into more heavy-handed regulation like zoning. Still, that could be provided, the funding could be provided by private investors and blended finance and all what we discussed today. But having these attractive deployments for purely market-based reasons, I highly doubt it. And one of the reasons, and now I'm finalizing my question, is that you need these sufficiently high connection rates to make your project feasible. And you're not always ensured having those when it's up to people to connect themselves. So I've been going a bit back and forth between letting the market handle things. Right now, I'm more in the heavy-handed business, because if we are to achieve these high deployment rates, I don't see it happening by itself with business as usual, where we spend a century on getting to 10%.
Thank you, Daniel. Thank you very much. Kristina, you have your hand raised.
Yeah, I support the notion that we need support mechanisms for this to happen. And I think there will be some kind of public-private investment that we haven't seen before. Before we have seen a lot of public investment, but we don't have enough funds right now if we're going to scale it up. So we really need these new structures, the blended finance, whatever we call them. And then I know me and Tobias, we have addressed this before, that we need also to consider carbon pricing much more than we have done before. I mean, carbon should come at a cost. Otherwise, gas will continue to be very cheap, which is not beneficial if we want the sustainable alternatives to progress. I will lower my hand. Tobias.
Yes, Kristina, I pretty much agree. Tobias, please.
Yeah, thank you very much. So, and also for the very interesting questions. So first of all, I mean, it's also a matter of business model. So what kind of business model do you have? And Kristina and I did another project for the IEA a couple of years ago, and together with other co-authors, we rewrote also an article about the business models, and it all has all to do with the pricing, of course, and pricing has to do with customer acceptance. And so we tried to elaborate a bit on that, but nevertheless, of course, we weren't able to find a one size fits all solution. So sorry to say that, but it always depends on the local conditions, and that's basically where the regulators come into play. So, for example, speaking for Germany, it's from my point of view, it's quite important that we have reliable legal and regulatory frameworks that make it for investors and for the operator more easy to foresee, for example, what are the risks and what are the framework long-term conditions, so that they have a clear basis for their planning. Secondly, what I would also say is that, for example, different market studies show that for Germany, at least, the district heating, the prices per kilowatt hours or megawatt hours are higher than in competing energy sources or heat sources. And so I think there's much more transparency needed. And for example, a nationwide platform, which is making transparent what are the tariffs that customers have to pay for district heating in different regions, that would make it would also be a positive contribution and also put some pressure on the operators and also the other parties involved, for example, the municipalities. And like Kristina mentioned, so I'm very much in favor of carbon pricing with the emissions trading system for all sectors. And for example, we are still lacking, for example, the building sector and also the transport sector. And so that would also contribute positively to the transformation. And last but not least, when it comes to the business model and in combination with the governance and ownership structures. So I see quite some advantages in cooperative structures. Why? Because the owners or the investors, if you will, the shareholders, are basically the customers. So that we have an identity with customers and identity. So the customers and the investors, which are basically the same persons, have to decide whether they want to earn a higher dividend next year, or if they have to basically or want to pay a lower tariff this year. And so since it's always a local cooperative, which depends on different circumconditions and framework conditions, so each cooperative is able to find out what is the right balance for the local conditions. And at least some case studies we have seen show that this mechanism works quite well.
Thank you, Tobias. Okay, we had quite an exhaustive answer. I hope, Sam, you're satisfied. We have another question somehow close to the one we just answered. So Johannes von Dorian asked, the investment must be seen in terms of return and be able to compete with other instruments on the market, which in turn means that the costs for the consumers, of district heating could increase to depreciation. How can it be ensured that the costs for end consumers are not too high compared to the cost for other heating solutions? So how we can keep the cost basically competitive due to the depreciation and so on. I think it's also related to kind of business model. I want to shortly reply.
Yeah, Daniel, you go first.
Please.
So I'll make it quick then this time. I think I'm not an accountant, but my very limited view is that the longer payback times or the longer project lifetimes that you consider in your feasibility study, so you can spread out essentially the depreciation over more years rather than having, let's say, a few years payback time required, then certainly that decreases your heat cost and makes you more competitive. But yeah, that was my small note. Kristina?
Thank you for being precise. Kristina, yes.
Yeah, no, I was thinking we have seen in Sweden now also a lot of price increases because transfer of costs are going from the producer to the consumer with higher fuel prices. And also for new investments to transfer costs over to the end user, I don't think it's feasible because it erodes the trust you need to have for district energy to work. So either you can do what people have done in some markets, you can cap the price to make sure that this doesn't happen. That has downsides because it makes the market less flexible. But what I think is really interesting when you are at an investment case is to think about the business setup. And you can also have patience capital. So you can have, if you have different investors coming in, they might need their payback in different time horizons. And there is a great case in Copenhagen with a pectin factory from the US. They wanted a 3-year, I think, payback period, and they had a lot of waste heat. And the local district heating company could have a much longer payback period to get the waste heat. So they made a business arrangement so that the American company was paid off earlier, and the district heating company exerted its patience capital and could be paid off later. So there are some twists you can do on the business arrangement. Tobias.
Thank you, Kristina. I like the practical example. Tobias.
I'm not quite sure if I got the question or if I understood it correctly, but maybe also what is discussed in Germany might contribute to an answer, namely the question of in German it's Anschlusszwang, so in English it's something like mandatory connection for the customers. So that would be very much in favor of the investors, of course. But the acceptance for the customers is not very high because, of course, nobody wants to be forced into some kind of system. But that's basically what works well and which is more vividly discussed currently. But when thinking about that, you have to really be cautious how to communicate that, and that only, from my perspective, only goes along if you can guarantee rather low prices or tariffs for a longer time. But that might be a mechanism also to balance out, on the one hand side, the investors' interest, and on the other hand side, the customer interests. And last but not least, that's also from a political point of view, this is quite sensitive. For example, in one expert interview, one mayor of a municipality said, well, actually, I have the plan to be re-elected. And so I won't implement any mandatory connection in my municipality because due to the rather low acceptance for this kind of measures, I'm risking I'm decreasing my re-election chances. So a mechanism which works quite well if it's balanced out, but which is politically very sensitive.
Thank you, Tobias. We have a quick question for you still from Donald. I don't know how to read it exactly, but suggest there are two key risks for these heating networks developers in relation to finance. I think, do you confirm or?
Yeah.
I can, yeah.
Yeah,
I don't know if I read it very well, but I just read as it's written. So suggest there are two key risks for the HM developers in relation to finance.
Sorry to interrupt. I think Donald provided these 2 points in the message. Two messages down.
Read another question, and then Donald. Oh, sorry, I was just reading in order. Sorry, Donald, my fault. Because in the meantime, another question arrived and split your message. So the first one is volume risk. This is addressed by zoning and the requirement to connect in an area zone. And two, price risk, where the price per kilowatt hour of heat to end user must be capped at the zero low carbon counterfactual. Who in the value chain is best placed to manage this risk? Thank you, Daniel. Tobias.
I'm not quite sure if I got the questions correctly, but maybe we already answered, or in my last quote, I already answered at least, or tried to answer the second question with the price risk. For example, with a mandatory connection, but also which would be the municipality as a player to implement that, but also talking about the ownership and governance structures with cooperatives. So that would be an approach to do that. And with the volume risk, also I would say the mandatory connection, but maybe also Donald, but there I'm not quite sure if I got it correctly. The zoning would be already a part of the answer, I would say. But please, Kristina and Daniel, add anything else from your point of view if you think that part of the questions are still open.
Anyone wants to add anything? Okay, otherwise we have 20 minutes left, so we have quite a good number of questions still to be replied. So I would go on. An anonymous in the writes, are there examples of other heating and cooling solutions that are identified as an asset class? I.e., is this a common definition within the industry? Okay, that could be very quick, Daniel.
Yeah, actually, maybe I would pass it on to perhaps Kristina. But my short answer is yes, because we do know that there are investors or funders specialized in this or specializing themselves in this. So obviously they have made these considerations and are considering it an asset class. But yeah, Kristina, happy to hear your take.
Yeah, thank you, Daniel. No, I think I would say no. And that's really why we have the project together with Daniel and Tobias, because it's not very common to consider district energy as an asset class. And many investors that we have come across over the years, they have either seen it as something new or very risky because they don't know of it. And that's why we thought we need to start talking about the infrastructure in the jargon of investors. And that's why we want to package what it could be in terms of an asset class.
Thank you very much, Kristina. Still, Donald, question for Daniel. From a utility industry participant as requested by Gabriele. Thank you, Donald, very much appreciated. That's really. Any thought on how the regulated asset-based RAB finance model successfully in place for electricity and gas networks throughout EU be applied successfully to heat networks? This is the approach now being proposed in recent legislation in the Netherlands and Ireland. It's quite similar to the question I want to ask you about the drug report and the RAB model. And the risking. Who wanna reply? Daniel, of course, but of course, Kristina and Tobias, feel free to add anything you think it's important. Daniel.
So I have a proposal. So we should have a webinar where we include the discussion of nuclear, biomass, and the perfect regulatory approach, because those are almost close to religious debates on whichever side you're on. I would say, having looked at regulation for some time now, not an expert, I think on all kinds. What we see in the US, for instance, with the regulatory asset base, is that sometimes utilities are blamed for over-investing. So I would certainly say, I think it's a good path to go to proceed on. I think perhaps, given my answer to Sem before, I think maybe we will see several parallel tracks, and we probably need to adjust along the way. So let's say that you proceed in Netherlands and in Ireland with the regulatory asset base. We will see other approaches, and I think we have a lot to learn there. So where I come from, academia, it says Energy Modeling Lab, but I'm also affiliated with Lund University. I think we have a lot of work to do in actually doing further and in-depth studies of the regulation of district heating, because it's a certain asset class, but it's also a certain sector where you have a natural monopoly, which is essentially facing competition, either actual competition from gas boilers and heat pumps and so on and so forth, but at least also regulatory competition in the sense that it's compared to the lowest cost, the low carbon alternative, as I think you mentioned. So my answer will be time will tell, but I think as we need to deploy a lot, and as this has a proven model, I would be confident in going with it, as long as there is as much transparency for the regulator as possible. I want the regulators to breathe down the necks of all the utilities, because that's, in my view, the only way that you can ensure low consumer prices in a monopoly-like situation.
Thank you very much, Daniel. Anyone wants to add anything? Kristina, Tobias? Otherwise, I can go to the following question. Okay. We have Patrick Schreiber writing, what kind of financial, non-financial covenants do you see on transactions? I don't know if he's targeting one specific panelist, but let's consider it to all panelists.
I don't think I understand the question, sorry.
To be honest, me neither. What kind of financial, non-financial covenants do you see on transaction? Patrick, if you are still there, do you wanna maybe you can raise your hand? I can give you the mic, or you can specify your question, elaborate more on your question on the question box. In the meantime, maybe I can try to answer Diana. Hi, Diana. In sense of EU regulations, what would support investment into DC heating, especially high capital technology, geothermal, etc.? How could we make the market more attractive for private capital? What does need to be implemented into existing taxonomy? That's quite a broad question. I think something that we are keeping discussing since a long time. Maybe try to keep your answer short. I think there's a lot to speak of. It's very interesting. So thank you, Diana. Tobias?
Maybe first of all, we would need to differentiate about what regulation we are talking about, and that's what we also ran into the different projects together with Kristina, for example, and Daniel, is that actually, for example, the European Action Plan on Financing Sustainable Growth, where the taxonomy is one package of, was aiming at channeling capital from financial markets away from unsustainable towards sustainable assets. So that was the ambition and the first and foremost, basically, objective of the action plan. But in practice, we have seen quite some obstacles. Why? Because the action plan, which is financial markets regulation, is not very well coordinated with the Energy Efficiency Directive, for example, or the Renewable Energy Directive. But when it comes to the operator and the owners, they have to comply with all the different regulations, and that's quite of a regulatory risk, I would say, and makes it really difficult, and doesn't make it as easy as it should be. So maybe that would be one part of the answer, but the other part of the answer would be the blended finance approach, that this might help because it's taking away the risks, or it is, by guarantees, for example, part of the risk, and this is optimizing the risk-return relationship for the private investor and financial markets like pension funds, and that hopefully helps to mobilize private investments in that area.
If I could also add, I think we need to create a real demand also for district energy. And again, if I go back to things like low temperature district heating, we have discussed what can you do on the policy side. Well, you can first of all make sure that you have incentives for renewables and for waste heat being at the same level. And you can also stipulate, for example, every time a public building is to be renovated or built, you have to consider if waste heat recovery is possible. So by these kind of means, you can demand district heating more and more. And if there is demand, there will be easier ways and more cost-efficient ways to provide supply.
Of course, very impressive point, right? Okay, so we have another question from David Sommerveld, this time more on the community approach, bottom-up approach. What role do civil society organization, community organization have in encouraging fellow citizens to both sign up to connect projects, to risk them, and to invest in community shares supporting the projects themselves? So, yeah, wanna reply? Tobias, please.
Maybe the question also could be an argument once again for the cooperative approach. To install or set up energy or heat cooperatives in municipalities, and by that, first of all, motivating the citizens, because the company then is their baby. So it also contributes to the identification with the project. And again, the motivation is there to make it as good as possible. And at the end of the day, the citizens benefit from either dividends or stable tariffs, depending on how they balance that out. And yeah, also what we must not underestimate is that at least what experience is showing, that it also has a very positive impact, I would say, on the spirit within the municipality, because it's a joint project of the citizens, and so it's some kind of teamwork, and that of course is also providing a positive dynamic. That's at least what the successful heat cooperatives show, and also energy cooperatives in the electricity market in Germany, for example. We have like 800 all over the nation, and what I just mentioned is basically drawn from their experiences.
Thank you, Tobias. Daniel, then Kristina.
Yeah, thanks. Yeah, I agree with Tobias, and I just wanted to add on top, anecdotally, what we see for in the case of the projects I followed in Denmark is that citizen finance, or I mean, I think the term crowdfunding became popular 10 years ago, but it's been existing within district heating for many more years, to my knowledge, and certainly it plays a big role. Just out of, again, anecdotally, when we see citizens or end users paying the full connection package, which in Danish numbers is around 20,000 euros, 25,000, something like that, we see 10 projects tend to fall. Whereas if they pay a smaller share, call it a few thousand euros, they have skin in the game, and they can actually make a substantial contribution to finance the project. So certainly it makes a difference. And we also see good experiences with local ambassadors, basically citizens that are not employed or paid by the company, but essentially just people who want district heating because they can see it as a nice solution, which are then helped with communication material and so on and so forth. So definitely the community plays a big role. I would agree.
Thank you, Kristina.
Yes, I think this is very interesting because now we start talking about something which is often forgotten in the energy transition, which is that it has to be just, fair, inclusive, all these kind of things. So with these cooperatives coming up, I really think we are fostering a new kind of activity. And with the upcoming years, you have to take this responsibility to provide social values as a district heating provider also. And if you can combine it, I think you can have a higher attraction of capital locally.
Okay, thank you. Then we have another question from Jure Zitzman. Harvesting waste heat from industry and other business is one of the key cornerstones for future district heating development. However, the current unstable business environment poses significant challenges to establishing long-term cooperation among business as waste heat sources and utilities. Are there any ongoing initiatives aimed at de-risking such projects? Additionally, what role can local authorities or municipalities play in facilitating and supporting the development of this project? This is more on waste heat, this question. Maybe, Kristina, you work a lot on waste heat so you Tobias in reward need and reuse it projects. You want to name a couple of examples very shortly?
Yeah, I think I already mentioned one here today, which is that you could have incentives for waste heat being at the same level as renewables, and you could make public buildings be like first movers in including waste heat. We have done a couple of studies also on different kinds of risks to waste heat, and I think most of them can be managed. A big one is to discuss how can you price waste heat. And we had a strange example in Denmark where you have additional taxes on waste heat to avoid that industries generate waste heat unnecessarily just to sell it and make a big profit. So I think you also need some stringency on the pricing mechanisms. And I hope that is coming more and more across Europe.
Thank you very much, Kristina. Then we have, it's not a question, it's more, I would say, an offering of help. Francis quotes, by far, Gamleo is offering solution to reduce risk. I would appreciate sharing that and look at the solution, how it could be contributing to the project risk mitigation. Best regards, Francis quotes. Thank you very much, Francis. You can contact Daniel. Daniel, maybe you can put your email address in the chat of the webinar so people can see it. Finally, last question for Patrick that is elaborating a little bit more. He said, as a credit analyst, I'm interested in understanding how covenants or KPIs are used to protect the lenders in case the project is not going as planned. Kristina, is your raised hand or it's an old hand?
It's an old hand.
Okay.
And so I don't have a good answer to the question.
Of course. Anyone has any reply on that? Tobias?
I'm not quite certain if I have a good answer to that, but I can try to give some hints on that. So first of all, I would say it's the guarantees. For example, the municipality needs to provide in order to protect the lenders, but for example, the municipality is also responsible for example, based on the municipal heat plans, to support developing a feasible and a successful business model. So, and taking out the risks, or first of all, identifying the risk and then to find specific mechanisms how to protect the investors, be it on the equity side or be it on the debt side, so the lender side. And one further aspect, since KPIs were mentioned, is again transparency. The more transparency you have, the lower the risks basically are, and because the complexity is reduced. And so what we try or have been trying over the last few years with our sustainability balance scorecard, I just briefly mentioned in my presentation, is first of all to translate the business model. First, technology, of course, that's the basis, and translate the technology into a business model and then translate the business model into the language of investors using these specific KPIs. And they provide transparencies, for example, about the returns, but also about liquidity and liquidity risk that might be existing, also about the decarbonization potential, which is really important to investors right now due to the taxonomy and other regulatory activities on the financial market side, and also, of course, making all the different risks transparent that might be related to that, and that is on the technology side, risks that existing there, political risks, regulatory risks, of course, liquidity risks, and so on. And the more transparent as a starting point the project is, the more efficient it is to find the right covenants to provide.
Thank you. Daniel.
Just very briefly, and being an engineer, venturing into this, I'm learning that economists and finance people have various ways to hedge against risk. Probably some smart people will find out ways where the risk can be mitigated on top of what Tobias said. But the short answer to what you may be asking is I haven't seen any specific ways of mitigating risk other than the usual one. So in case you are on a more senior level, so you have the typical debt equity mezzanine levels. So in case a project goes the wrong way, you'll be repaid in that order. But there may be additional aspects, as Tobias mentioned. Of course, the regulation is helpful in reaching or decreasing risk.
Thank you, Daniel. I think we don't have any other question. Thank you. I think
I might have some further.
Sorry, Tobias, I didn't see your hand.
Answer to that.
Please.
Daniel was explicitly mentioning the mitigation of risks. So what we learned in expert interviews is that a certain group of investors, but there are only very few ones in Europe so far, are taking, in addition, the role of being the project developer, or they say or mention as a precondition in order to be willing to finance district heating, to be involved as early as possible in the planning process. Why? Because then they understand from scratch what the project is all about and what potential risks are, and this is the basis for them in order to do a proactive risk management and proactive mitigation. But since the question was from the debt perspective, I do not know whether that is really the answer to that, because the investment funds that are proactively following this approach are rather on the equity side or on the mezzanine side. So, but nevertheless, the earlier, no matter what kind of investor it is involved, the better works the risk mitigation from the start.
Thank you, Tobias. Okay, it's already known. Our time is over. We would have a lot of other questions, but I'm glad to see that the audience also pose a lot of them. So I'm great. I'm very happy to see that there was a lot of interest in this quite important topic. I would like to thank you, Kristina, Daniel, and Tobias, for being our experts today. Of course, other webinars on this subject will come. Here you can see the contact. So please contact Daniel if you have any data or resources could be useful for him, Kristina and Tobias for any inquiries about sustainable finance for district heating and cooling, taxonomy, and other related topics. Of course, the slide will be shared to the participants, so don't worry. We're gonna receive it in the coming days. So thank you again. Have a great lunch, and see you very, very soon. Thank you. Have a nice day.
Thank you. Bye-bye.
Thank you. Bye.